And joining us now to share his commentary on the day's markets performance is Cobus Potgieter from Southern Cross Capital. Cobus, thanks so much for joining us this afternoon. And let's start off with those trade talk deals. Things seem to be looking up when it comes to US and India, but over in Asia, there seems to be some troubles getting a deal through with Japan, with Trump even threatening Japan with tariffs of up to 35% if the nation doesn't reach a deal with Washington before the July 9th deadline. It does seem like markets aren't really reacting to any of the news. Are we just applying taco trade again?
Yes, there's certainly some of that. Again, the market is sort of calling the bluff more than anything else. I would think this close to the deadline, the market would have been more nervous, but Trump himself and his spokespeople a couple of weeks ago initially indicated a likelihood of an extension of that hard deadline, given that they simply haven't been able to reach all of the major trading partners and are occupied in these negotiations forthwith. South Africa, amongst others, being bumped to the back of the queue, probably correlated to the demise of Elon Musk's influence. But Japan is a sticking point for Trump. Their post-World War II recovery was largely driven by this new export reindustrialization through the export market, with a particular focus on the automotive sector. And on that basis, they've become a dominant player in the US market, a free market, which historically hasn't applied tariffs to those vehicles to protect their own automobile industry. And because of that effect, there's an enormous trade deficit to Japan. Of course, you get into the intricacies of the merits or how problematic that is in the long run ultimately, but that's neither here nor there. Trump doesn't like it, and they are trying to negotiate hard to settle on some sort of compromise, whilst also getting American businesses additional access to the Japanese market. But for the moment, the market seems to be quite relaxed about this, believing that either the can will be kicked down the road or a compromise will be found.
And sticking with Trump, his big, beautiful bill making headlines this week, and the latest version was passed by Senate, and it includes bigger tax credits, which could make it cheaper for chip manufacturers to build plants in the US. Your reading on that, and whether it's enough incentive for those big chip makers to invest in further in Washington?
I think that's certainly the trend that we will continue to observe. Intel itself has scaled back off the back of a somewhat unsuccessful rollout. However, the Asian players have certainly started rolling out in the US quite aggressively, and it's clear that the political pressure for that so-called strategic asset to be US based is becoming an unassailable hurdle, and ultimately that is the direction things will go. The bill itself getting passed is a little bit tricky.
Yes.
We saw essentially McCarthy pushing the bill through the House with haste. The bill itself is in excess of 600 pages, very complicated. And amongst other things, something that a lot of the House of Representatives members didn't even cotton on to was that it contained a 10-year waiver on any sort of AI regulation at the state level, which of course these people represent individual states and ultimately became upset about. So by the time the Senate got this approved with some of their own little riders, it's not the amendments that the Senate have made that are upsetting the members of the House. It's actually these things they approved before that they now reckon they shouldn't have. But because the Senate made amendments, they now have the opportunity to try and force changes as well. And now they have more dissent within the House than they had before. And it looks like if they lose 3 votes, they won't be able to push this through, and they've lost more than that as things stand. So there will potentially be, despite the noise that Trump is making, further amendments. But ultimately, it's quite clear that we are going to sit with quite a hole in the U.S. fiscus going forward. Once all of these smaller changes have been pushed through, it's going to be quite a disruptive event.
Funny how things have changed since December. You would never have thought that we'd be dealing with, matters like this. Let's move over to some local company news. So Sun International and Pearmint calling it quits after, they've struggled to get regulatory approval for that tie-up. I see the share price is up 8% on the back of that. Markets seem to be liking the news.
Yes. I mean, this is sort of a classic case of empire building where the market disliked what Sun International were doing in an environment where most analysts felt they should have been focusing on optimizing their existing portfolio, and there was a lot of optimization required in the wake of COVID, essentially trying to overpay for Piedmont, and a couple of issues there. It would have led to essentially between themselves and Soho. Would have a duopoly on gambling licenses, all the regional gambling licenses in the country, Piedmont being the only significant third-party player. Because of the concentration in Gauteng, they would have had to sell some of the best assets to get this deal through at all, which, of course, negated the value of overpaying for this asset in the first place. And then, more generally, the competition issues and the way the competition authorities have been pushing back and also dragging their feet. And it demonstrates a bit of a risk in these deals, because it's not like this deal was voted through by both parties. It was decided. And yes, the CC had rejected it, but typically you go to tribunal first. And the only real issue is the date was set beyond the long stop date, and they are taking this offering, and there might have been, assuming Piedmont was listed, which fortunately it isn't, but we've seen the scenario in the listed space before. There might have been a scenario where the minority shareholders would be sit holding the bag. Something similar happened to Gold Reef during the 2008 financial crisis. Precisely this happened when Soho tried to acquire Gold Reef at the time and essentially walked away from the deal on procedural basis because the long stop dates had been missed. Because in hindsight, after a market crash, they realized they were overpaying for this. But I mean, it's certainly it's the expected outcome, but clearly the market was still worried about it, and shareholders quite happy that the CC had put a stop to this, and the parties had decided to walk away.
All right, let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what other industry players find interesting.
Going for Datatech, specifically following their latest results, they're in the right space in the market globally. As you know, they provide services like cybersecurity and networking and that type of thing, and also software sales and looking after company systems. If you take a look at their valuation compared to their peers, they're not expensive. I think they're sitting on a forward price earnings of about 10 versus the industry of about 13, 14. So there's lots of scope for improvement there. They've got the market mood behind them. They are an obvious beneficiary of the move to AI, because such a lot of what they do is involved with that. The prices had a great run over the past year. I still think there's scope for further improvement in that.
So my pick today is Bidvest. It's a stock that's sold off quite a bit over the past 1 year, and I think it's because the last two halves that they've reported, they've disappointed. They've either come flat or marginally behind. I think this was largely because of the point in the cycle that they were in. The freight business struggled with volumes because of no maize, and also the freight issues going into the ports. They were restructuring, they were making acquisitions internationally, so all the debt accumulated. I think over the next 6 to 12 months, what you're going to see is deleveraging coming through, volumes in the ports starting to improve, and those international businesses beginning to contribute. For the current valuation that stock is trading at, I think you have a reasonable margin of safety that allows you to get in and hold on and wait and see all of this coming through. I think the management team has proven themselves over time with their business model. They've stuck to it, and I think you'll see the benefit over the short to medium term.
So both Roy and Rickers are picking local counters, Datatech and Bidvest. Just your analysis on those stocks.
I like both of them. Datatech in hindsight was the best way for a South African or a JSE shareholder to play the AI boom, essentially making shovels in the gold rush. Their corporate clients overseas are upgrading hardware, in the pursuit of AI systems rollout, and of course their focus on security in this very insecure IT environment that we are entering, partially because of AI and also because of geopolitical risks. That's benefited them enormously. There is at this level, a little bit of a risk to execution, and the shares a bit toppy. I realize he's comparing their multiples to their global peers. Ours tend to trade at weaker multiples, and something like Bytes, which came with an update this morning, that was quite disappointing and essentially wiped out the entire rally that they had sustained 6 months ago, does demonstrate the risk when you are essentially dependent on your corporate clients continuously upgrading their underlying systems. But I like the stock, and I agree at a PE of 10, it's certainly not demanding. Similarly, Bidvest, well, quite the opposite, but also an attractive valuation. This is historically cheap for the stock, somewhat appropriately, given that the latest adventure into these hygiene services businesses overseas, in particular in the Canadian and the US markets, where they have less of a footprint, which are considered more competitive markets, betting down Satran and continuing to execute the strategy that comes with a little bit more risk, and more generally, of course, locally, the ports business being very much exposed to South African GDP and execution risk within the likes of Transnet. However, this is quite a cheap entry point, and assuming that it was at that stage in the cycle where we saw a bit of a pullback in volumes, and these volumes could recover from here. And of course, they execute on the offshore rollout, which, to be fair, historically they've demonstrated a track record of being able to do that in the likes of the UK and the Australian markets in particular. Hopefully it can do well from here, but it's quite a cheap entry point, and the yield is very attractive as well at this stage. So I like both of those calls.
Okay, so you like both of those counters, but both not your stock pick. Where are you seeing opportunity today?
So my stock pick today, and I think it's quite rare for an asset manager to pick another asset manager's share as a buyer, but ours today is 91. When 91 came to market, of course, unbundling, it used to be called Investec Asset Management. It came out of Investec and became a separately listed entity. We were quite surprised by how low their margins were. And how they were very institutionally focused, which essentially meant that they had customers who have pricing ability, the ability to move their business around, and could bully them on pricing. So they didn't have these massive attractive retail books that the other major asset managers had, and therefore were less profitable given the size of the book. That over time has shifted. Amongst other things, they've done this deal with Sanlam Asset Management, where they have flipped in all of those teams. It seems they are embedding them with the 91. They've got a distribution agreement with Sanlam now, which of course now lacks its own asset management business, so they are incentivized through some sort of a fee arrangement to raise capital on behalf of 91. And generally speaking, we just like the model. Unlike the other major asset managers, they have siloed teams with completely distinctive strategies and opportunities. So there's no sort of house view that you're getting across the range of funds. They've got 5 very distinct teams, and all of them pretty good, some of them better than others. But the point is, you're quite diversified from a style and concentration basis, and almost trying to adopt that sort of a boutique approach within a massive institutional asset manager. So the returns tend to be high quality, the product's pretty good, and add some retail distribution onto that, and hopefully we'll see some nice expansion from both the revenue and a margin perspective going forward.
All right, Cobus, thanks so much for your time and sharing your insights. That was Cobus Potgieter from Southern Cross Capital.